Good evening, everyone, and thank you for joining us this evening for the post-mortem of the Bitcoin halving run by ByteTree with a lineup of fantastic industry special guests. I'll be your host today, CEO of ByteTree, James Bennett. I'm joined by Charlie Morris, co-founder and chairman, as well as our CTO, Mark Griffiths, who is in the control room running the show for us today. So we are extremely excited to be running this show with you. And I'll give you a quick overview of the agenda before we dive into the meat of the presentation. So we will start with an introduction on the halving, what has happened, and what do we expect in the next in the coming weeks. Then we'll talk to our special guests in 4 different slots of 30 minutes each, interviewing across a range of topics. And then we'll conclude there. You're welcome to ask questions throughout the event in the box, and we have our wonderful marketing guru, Laura, will be there to answer those and direct those questions to us. Okay, fantastic. So let's get going. So the halving has officially happened as of yesterday. We went from 12.5 to 6.25 blocks rewarded per new block. So what happened was particularly exciting was that the mining company F2 Pool actually put a message into the penultimate block stating that the New York Times on the 9th of April reported that there was a $2.3 trillion injection from the Fed into the economy that far exceeded the previous 2008 injection. So that is foreshadowing the inflationary environment that we all expect to come out of the back of this huge monetary sort of easing. And amongst others, we had Paul Tudor Jones, legendary hedge fund manager, saying that he has allocated between 1% and 2% of a huge portfolio to this emerging asset class, specifically to Bitcoin. Very exciting times. So yes, the halving has arrived, and we've dropped from a 4% inflation rate to a 2% inflation rate for the next 4 years. And we have another halving to look forward to after that. So I'd quite like to have a quick look at a few charts in order to frame what the previous halvings have looked like, and also this current one, so we can get an idea of where we think price and volatility will sit over the coming months ahead. So control, Mr. Mark Griffiths, can you please bring up price versus volatility in 2012? Okay, so here on the left side of the chart, we can see the volatility over a 30-day rolling window. We peaked at about, and I should say that the dotted line, the vertical line in the middle of the chart, marks when the halving happened, and the gray line marks the price. So we can see how was price volatility occurring in the run-up to the halving, and how did price respond. So we can see about 2 months before the 2012 halving, we got to 150% volatility, very high. Price had a relatively straight run at the halving, and subsequently started to climb in the following months. If we can then pull up 2016, what we can see there, a similar sort of pattern. A few months before the halving, we reached about 80% volatility. The halving event itself was a high volatility event, and then price struggled to retain its level over the months ahead, and only climbing around 6 months after that. So finally, the 2020 halving that we had yesterday, similar sort of story. A month before the halving, we saw a peak in volatility. People get very excited around these events. This time, price crashed. Big liquidation event in the markets on the 12th of March. But that gives us a really strong foundation to build off. You can see that Bitcoin has trended down since July of last year, and is now getting ready to break through that trend at about 10,500 is breaking the trend. So it's an extremely exciting time. We've been building steadily up to this point, and we're very positive for the months ahead. So that's it from me. I'll pass over to our chairman, Charlie Morris, to say a bit about the past halvings, and then we will get stuck into the interviews. Charlie, over to you.
Great. So I have no idea how to see the charts. I can't see anything on my screen, so I'm just going to talk. Right. So in 2012, we had a halving, and the price didn't go up, and it didn't go up in 2016, and it hasn't gone up this time. So that is all I have to say about halvings this time, James. Over to you. Just to wind up, James, just getting you going. No, we've got loads to talk about here. So the look on his face is worth it for just for that. So this is a post-halving party. The blockchain Olympics come round every 4 years. This is a very important moment, and we would like to talk about through past halvings in a bit more detail. I think the point is, back in 2012, we have a sort of valuation framework at ByteTree. And the price of Bitcoin was trading at its discount to what we believe to be its fair value. And I wasn't involved in Bitcoin in 2012. I ridiculously dismissed it back in 2011 when someone told me about it. But I came back in 2013. But what I do know, one of our guests who's coming later was there at the halving in 2012, Paul Gordon. And he will tell you that it really wasn't much of a fanfare, not much happened. There was a little bit of a buzz beforehand, but really not much. But the 2016 I was a part of, and I do remember that very clearly. And what we saw was the price go from a discount in the run up, because we had a big bear market in 2014, a settling down period in 2015, and the price of Bitcoin was pretty cheap. And then that happened in July, but in June the price ran up as the hike came in, and so the price of Bitcoin went to a premium and actually crashed a month before halving as the speculators got cold feet. It wasn't until the end of the year, till around November, December time, that Bitcoin then carried on to make a new high for the year. And then the recent halving that we've basically spent quite a long time at a premium. So in the run up. So in 2012 we went into it in a discount. Cheap bitcoins went in, and the whole thing was a bit of a non-event. It interrupted an uptrend that was already there. In 2016 it was the early stages of a bull market that was just kind of getting going, and there was a bit of volatility. This time it's been hugely hyped, including what we're doing right now, having a lot of fun around it. But the price of Bitcoin was about 80% above fair value earlier this year. Obviously, the COVID crisis corrected that. We don't really know, looking at the price, in years to come and looking back, we won't really know how much is the COVID crisis, how much is Bitcoin network, and how much is halving hype. Trying to separate the three things is really difficult. But right now the Bitcoin premium is about 30% above fair value, and that's fine. But we think, looking at our metrics, the whole space is doing well, and we think it's onwards and upwards from here.
Fabulous. Okay, so now it's time for our first panel event of the evening. I can see we have the wonderful Mona Eliza, founder and CEO of Avant-Garde Finance, and the one of the brains behind Melon. We have Laurent Cassis, the MD at 21 Shares and Amun. And we also have James Bowater, who is the founder of the Crypto Insider under the City AM, and has done a huge amount taking crypto or digital assets mainstream in London. So before I hand over to the guests, this first section is going to be talking about access to digital assets across the whole spectrum, from retail to institutional. I just wanted to drop in a piece of research I read earlier this week from Acuity that said of traditional trading firms that had made a decision not to trade digital assets, 97% will consider the opportunity again in the next 2 years. And 45% were planning to revisit the idea in 6 months or less. We've seen Grayscale Investment Trust hit an all-time high in assets under management, 3.3 billion, with $500 million invested in Q1 alone. And on top of that, a report from PwC that just came out mentioned that assets under management of crypto funds grew to $2 billion by the end of 2019, which was double the year before. And the average size of those funds in terms of the AUM increased from 4.3 to $8.2 million. So while we may not recognize or see the signs, there are certainly undercurrents and tones of this industry transforming in front of our eyes. So with that said, we will kick off. Laurent Cassis, MD at 21 Shares and Amun. Would you like to give a short introduction to yourself?
Sure. Thanks, James, and thanks for the whole team, Charlie, Mark. It's a delight to be part of this event again that Charlie and I actually witnessed 4 years ago. So I'm very delighted. I've been with 21 Shares now for just under a year. I was the CEO of XBT Provider prior to this in Sweden, and I've been fascinated by trying to list products, financial products, such as ETFs, ETPs, ETNs, ETCs, whatever you want to call them, with the underlying of crypto assets. And I was fortunate to be able to do this with XBT. I am now fortunate to do it with 21 Shares, a Swiss-based issuer of crypto ETPs. And I think the place is pretty much open to any other contenders. We've not had many. And it's a bit of a shame, really, because when you look at the landscape in Europe, particularly, because I can only talk about the European markets, it's very much based on two issuers in the conventional markets. You've got structured products, of course, but they're obviously a lot harder to access. But the real, Bitcoin ETP that we've seen so far are the two companies I mentioned. And there's not been any other competitors since. So from that perspective, I think there's definitely place for other contenders. I think 21 Shares has done a great job by listing 11 products today, including the very recent one, which is a short inverse Bitcoin ETP, which is a first. We've never had that before on the conventional market using an ETP wrapper, where you can effectively participate in the performance of the inverse of Bitcoin when you feel that the market is going down. So this has been particularly good in the last couple of days, because we saw a slight dip 3 days ago, and then it suddenly came back. So now there is a choice for investors, particularly retail and institutional investors, to invest in conventional regulated product using cryptocurrency as underlying, and in a very normal conventional environment, which is the equity markets, and this just by using your conventional broker. So if you look at what these two issues have done, they've paved the way for the institutional markets to literally get a grip on the underlying assets within their portfolio, within their prime brokers, within their conventional asset allocation, using these type of vehicle, which are very much suited for these portfolios in a conventional environment. And this is exactly what we saw with the likes of the underlying assets such as gold, some 16, 17 years ago, that were issued by another commodities ETF issuer in the UK. And now, obviously, you're starting to see more traction. You've mentioned the US issuer that has gained a huge amount of assets, and that's great, and we want to see more. And we're hoping that in Europe, this is also going to attract a lot more European investors, particularly retail. The market is open. They just use their retail broker, and there's plenty out there that they can access. The products are available in various currencies, so you don't really get shaved by the FX rates that you would generally have if you're trading US dollar and your broker can only offer euros or sterling or even Swiss francs. So these products have got a very good mix, and there's various themes available. You can have a basket, and you can have various other crypto assets. So I think we're just scratching the surface in terms of getting assets invested in these products. And with now this with this halving, I'm hoping that we were going to get a lot more retail interest, and people are going to start getting more involved in these products.
Fabulous. Thank you very much, Laurent. It is so exciting to see so many different types of products coming out, including the short Bitcoin ETP that you recently launched. Very innovative. And on the note of innovation in this space, we're extremely excited to have Mona with us, who has created a decentralized fund management platform based on Ethereum. But I won't say any more. Mona, please can you give us an introduction to yourself and what you do in the space?
Yeah, hi. Thanks for having me here. It's really exciting participating in the events around this kind of big event. The Halving. We got into this space just over 3 years ago. We sort of saw Ethereum, and we saw the potential for all these new types of assets to be issued on Ethereum. And the one kind of conviction I had back then was the future is tokenized, whether that's crypto assets to start, but in future equities, bonds, anything you can think of really that has a value will be tokenized, because why not? It's every single metric that you measure anything by in finance, it's much more efficient, it's faster, it's immediate settlement. For me, this part is not non-questionable. But the interesting kind of afterthought that came was, well, if everything is going to be tokenized, then why do we have to rely on such archaic financial infrastructure? Because anyone who understands kind of the back office, middle office engines of how finance works knows that it's a terribly inefficient, expensive process. But it's for good reasons, because until now we've never had ways of ensuring trust between counterparties other than those of financial intermediaries. However, now we do have alternative means of establishing trust between two parties or between multiple parties, and that's a technology enforcement, that's blockchain technology. And so what we thought is, well, wow, if you have all this kind of functionality, if you have a tokenized future, then essentially you can kind of encode all kind of operational administrative functionality that a financial intermediary would usually do. So what we do is we basically automate asset management protocol. We enable the same level of trust between counterparties, except without the financial intermediaries in the middle. Very importantly, investors in any of the kind of decentralized products that are built on our protocol always have full custody of their assets at all time. They are very unconventional in that sense. But my belief is, if you really want to diversify a portfolio, then in order to achieve that full diversity, you also want to ensure a complete lack of correlation between the traditional financial sector and the blockchain financial sector, because the risk is that if something systemic happens in traditional finance and you're invested in a traditional version of a crypto product, then that may suffer too. But if you're wholly, in full custody of an asset on blockchain and no one else owns it but you, then you will always, you will sort of be hedged against that event. And for me, that's the real value of these pure crypto tokens. Now, when we start to enter, things like tokenized equity and tokenized cars and tokenized art, that's a different story. But crypto, in the pure sense, I think it's a self-custody story. So anyway, we built Melon, the asset management protocol. It's the first fully decentralized asset management protocol to hit the mainnet. It also became the first protocol, or we became the first team to fully decentralize its governance. And we're now continuing development and taking it from a V1.0 to a V2.0 gradually. Trying to make it easier to use. We're trying to improve the functionality, increase the feature set. And we're starting to see some really good feedback on that, but it's still very early days. And I'm very aware that what we're doing is very cutting edge and probably not as user friendly as some of the solutions, the other solutions being talked about here today.
It's certainly getting there, and I find it quite confusing to describe Melon, because it was avant-garde, and you led that, and then you decentralized it. So you kind of question yourself whether was it built by anyone?
So no, it was actually Melonport. It was Melonport, a company that built Melon, and then we dissolved Melonport after we decentralized the governments.
Okay, so Melonport doesn't exist.
Yeah, so Avantgarde is actually relatively new, and we applied for the lead developer position a few months ago, but we're not the only project now building on Melon. It's kind of open for anyone to build on.
I see. Okay. Yeah, really, really fascinating. I hadn't really thought about the bit that you said about if the traditional financial system goes boom, then these instruments. Laurent, sorry to point fingers, but some of these instruments would also be at risk. I think we'll hear from Danny Masters later about his approach to that in putting tokenized gold on the Bitcoin blockchain. But similarly, exactly in line with what you guys are doing is creating that true decentralization in the fund management in digital assets, and it's a really exciting project. So then, sort of passing the baton over to our third panelist on this first section, Mr. James Bowater, who I must say has done an absolutely fantastic job of boosting. We're here in London today, the capital city of the UK, boosting the profile for digital assets. Today is their second birthday of the Crypto Insider, which goes out in the City AM, I believe, fortnightly in a double-page spread. James, would you like to introduce yourself and tell us a little bit about sort of how you've driven the digital asset space forward in London?
I'm probably have to put Luna down now, because she's getting a little bit frustrated.
Oh, you can keep her. Dogs are allowed.
And if I yelp, it's my fault. Anyway, no thanks, James. I'm certainly not as knowledgeable as my esteemed co-panelists. I came into this space, gosh, as you said, 2 years ago, although the actual birthday is the 18th of June. Today's sort of the anniversary of joining City AM in partnership to create Crypto AM. But I came in with zero knowledge, and I declared that at the beginning. I'm not a journalist either, and that would be incredibly unfair on any other journalists in City AM if I said that. I guess what I do is, well, what I set out to do is to educate the audience as I learnt. And the only way to learn is to actually get out there and show up. And as I think you'll probably attest to, I've been to literally every single possible meeting of everything that you can imagine. Although, having said that, I did accidentally get involved in the creation of a stablecoin back in 2014 without really knowing what that was. But it was a gold-backed thing called the Hope Gold coin, and it was underpinned by the in-ground reserves of a New York Stock Exchange quoted mining business. Stop it, Luna. Anyway, so it resonated in the back of my mind, and then I was also involved in the area of authentication. So, of course, blockchain is transparency, trust, and all that kind of stuff. Digitization is creating a more frictionless environment, enabling 24/7 trading. Markets don't close, and there's always that stuff going on. But 2 years is an astonishingly long time in this business now. I mean, I think they call it in dog years, forgive the pun, sort of 10 years for everyone, isn't it? So I sort of feel like
James, you have by far and away done more events, I think, than all of us put together. So, you came in when this industry had peaked at its sort of mass kind of retail acknowledgement ever in its history. And the last 2 years has been somewhat of a consolidation in our understanding, of different tokens, of Bitcoin and how central it is, and of course in the price. So, I mean, how have you seen the last sort of 2 years as you've been going to these events and speaking to all the people that you have, the different cities across Europe? Do you think we're moving in the right direction, or are we moving?
I really do, and actually, I mean, it's interesting that you say that I came into it at that sort of heady time of actually what was probably the worst possible thing to happen, which was all this sort of Wild West craziness, and seeing these bright young kids raising masses of money, and then being not necessarily advised terribly well, or just not really paying much attention, intermingled with out-and-out scam artists, gave the whole thing a really bad reputation. I persevered because I think it's the underlying technology that's actually quite interesting, and that the journey is only really just beginning. And I think you've got Dominic Frisby on another panel. I remember I turned up at I think it was a Coin Geek thing where he was speaking, and he was giving a sort of parallel about the various bubbles, and there's absolutely no way that we are in a bubble yet. And I think that he said that that all the previous bubbles had been a multiple of the S&P 500. In order for us to be a bubble, we'd have to be in the trillions of dollars. So I think we really are completely at the beginning. And the other thing that I've noticed is that because of the media hype and the interest, the whole blockchain thing stimulated a bunch of people doing projects that weren't needed and weren't ready. And I think it all comes down to the need for regulation, not to stifle technological advancement, but to actually protect both the project drivers and also the people that they're interacting with.
Absolutely.
It's what I've really enjoyed seeing over the last 2 years is actually how the bad actors are being kind of, washed out. And that tends to happen in any unregulated space, I think, because unregulated spaces attract Wild West. It didn't mean that crypto per se was bad or blockchain was bad. It was just that because it was unregulated, unscrupulous people could, get involved and try and frankly just scam the money out.
Yes, absolutely.
We've seen plenty of examples.
The regulation makes a big difference.
Sorry.
If I can, I just want to pass back to Mr. Laurent on that point. I mean, the regulation, it really makes a difference. Do we need, when we're looking at financial products and what's available, do we need an ETF in order to be considered sort of truly regulated, Laurent, or is an ETP or sort of a different variation of an exchange traded product, so a note,
So
the same thing?
yeah, I mean, the ETP is an umbrella of words that obviously highlights or describes many vehicle. Obviously, it's exchange traded instrument, product, vehicle, and behind there's obviously a lot more that people need to be worried or concerned in terms of the risk factor. And everyone talks about the Bitcoin ETF in the US. We have an equivalent in Europe. We've got two, and they are working very well. They've been around now for quite some time. And it's just a question of how you want to expose the underlying instrument within that product. They're not funds, at least in Europe, and certainly not in the US. There would be trust. And obviously, how do you position them in a regulated environment? How do you give them more integrity? And of course, you can have your usual Cayman BVI registered companies that can issue offshore vehicles, and that doesn't attract a lot of retail investor. Or you can go onshore and attract a lot more investors within conventional and totally understandable environments that people are comfortable with, such as, for instance, the ETF world in Dublin. Most of the ETF are registered there. You've got a lot in terms of retail registered in Luxembourg. We decided to register ours in Switzerland. That can be passported, and then within obviously a regulatory framework, you can distribute these products throughout Europe. Now, of course, these products, we don't stop them from being accessible throughout the world, but we state clearly, and this is why when we use the term regulated, there is a prospectus that exactly talks about the risk factor that everyone should be defined and looking at. And this is what, for instance, you've been seeing in the last couple of weeks with the oil markets, where people have been buying so-called oil products, and they're not actually reflecting these underlying assets. Whereas, with an
can I stop you there?
Sorry?
Because we're coming into the end of the segment. I was waiting for you to pause for breath. I just wanted to point behind you. It says Cyprus bad cut. Is that referring to your haircut? Oh, it's bail out. I thought it said Cyprus bad cut. I thought it was a advert for a barber. Looking at your
No, so I use Cyprus bailout because if you remember on the last halving, that was some of the causes why people actually moved in and why people invested in crypto. So that was actually one of the main reasons why after the halving, people put a lot of money in cryptos.
Absolutely. Charlie is desperate to have his session, so we will be moving on very shortly. But before we do that, I would like to conclude with a quick fire round. This is a 20 seconds, and you will be cut off by the buzzer. The question is regulated crypto an oxymoron? Can you have regulated crypto? We'll start with Mona.
Yes. Yeah. Sorry. I mean that kind of two-part. Basically, yes and no. I mean, I'm going to have to say yes and no. I think it's possible I think it's possible for both worlds to be in parallel. I don't see why not.
Yes.
Like anything else, by the way.
Like anything else. Laurent, would you?
Well, you look at gold, it's unregulated. Currency are unregulated. Most of the underlying assets are unregulated. So why can you not have a Bitcoin ETF, ETP in the market? So I think it's not an oxymoron. There is a lot of scopes out there. We're actually only copying what people have done in the past, using crypto and making it easy for everyone to access.
Okay, and James, last word from you if you're still with us. Okay, he may have stepped away. In which case, on that, can we have regulation in Bitcoin?
Hello. Sorry. I did the mute thing. I thought I'd actually pushed it. No, I was going to agree. I was going to agree that it absolutely can coexist, and that regulation is necessary as long as it doesn't stifle progress technologically.
Yeah, absolutely.
Fabulous. Okay, Mona, James, Laurent, thank you so much for joining us today. I'm going to hand it over to Charlie for his segment. And Charlie, over to you. Thank you, guys.
Thanks a lot.
Thank you. Thank you, everyone.
Great show. Bye.
Bye.
Now, can you silence the mark? Silence that last panel. We never hear from them again, particularly Laurent. And no more French people on the show. So I'm going to welcome Paul Gordon, who's well known to the London blockchain community. Dominic Frisby, who's well known in financial circles as an author at Money Week and who wrote the book Bitcoin. And John Matonis, who's world famous in Bitcoin, who was a founding member of the Bitcoin Foundation. So we've actually got Bitcoin royalty on the show today. In fact, we've got the entire royal family in front of us, which is pretty exciting stuff.
Somebody lost some hair, though.
Yes,
yeah,
well,
I'm afraid.
Not you, Paul.
In fact, John, you've got by far the most hair of all.
Well, let's hope it stays that way.
Yeah. Well, look, before I'm going to dig into our topics, we had quite a good question about what happened the other night. Has anyone got a thought about? I know this is short term. We don't speculate too much on little price moves, but who's got a thought? And just raise your hand and speak if you want to go first.
I'll start off. I mean, the whole thing for me.
What happened on Saturday night?
The whole thing for me kind of reminded me a little bit of the way New Year's Eve is for me. It's very anticlimactic. You're sitting around, you're waiting, and then nothing really changes, and you go to bed. And it happens every 4 years instead of every 1 year.
I like it. So there's a hype in advance of it, and then there's nothing to.
But I will add one thing though, Charlie. Is I think the next hardening that we have in 4 more years, we will actually see it simulcast on CNBC and Bloomberg. So you'll be out of a job.
I thought we'd have that this time. I was actually shocked. I was looking at the front page of the Financial Times today. No halving anywhere. Where was it?
Right.
Paul, do you have a view on this? I've never heard him speak so much sense in my entire life.
Sorry, there you go. Thank you, Charlie. Thank you. No, thank you. No, I just find it a little bit bizarre, really. I mean, people talk about supply shock, and you couldn't have a more telegraphed supply shock in the history of anything. It was kind of telegraphed 11 years ago when the code was written that it was coming. and it would happen at this time, or roughly at this time every 4 years. I think the big question mark has always been, does it impact, and more so in the last two halvings probably than the first one, in terms of how it impacts the miners and what it will do to the hash rate and essentially the security of the network. Fortunately, this time we had a virtual halving by the price crashing virtually overnight a few weeks ago. So that tested the miners, and it quite quickly forced some of the more inefficient ones off the network. So we saw the hash rate dropped about 25 to 30%. It coped, it survived. The network's still pretty secure with 90 exahashes rather than 120 exahashes of power behind it. So I don't know. I think it's good, it's fun, but at the end of the day, it's designed. Bitcoin's designed and it's proven itself robust to cope with all these things. It's designed to be able to accommodate drops in hash rate as well as rises in hash rate, and to maintain the incentives for miners. So it should be just business as usual. Nothing broke. That's the good thing. We can just carry on.
That's the brilliance of the design, isn't it? You've got something for the financiers, you've got something for the workers, and you've got something for the free market. John, do you mind just telling me more about your founding role in the Bitcoin Foundation, what that meant, and how you've enjoyed the last decade?
Well, sure. The Bitcoin Foundation originally was founded in 2012. And it was a group of 5 of us originally. The original funders were Roger Ver and the Mt. Gox team. That's what originally launched the foundation. And the purpose at that time in 2012 was primarily to fund the core development team. The core development team was volunteers at that time, worried about leaving jobs and not getting paid because they're doing Bitcoin work. So as an original objective, that's very noble. And in doing that, we were able to attract Gavin Andreessen. We were not able to get all of the developers. I don't think you would want to get all of the developers. But in that original launch plan, the climate at the time was such that the people in the Bitcoin community were a little bit worried about outside influence in the development community. So an attempt was made in signing up developers and compensating developers through the foundation that they would also have to reveal and disclose any other sources of funding, that they were getting sources of funding from other states, other governments to work on Bitcoin. So that was done and that was accomplished. One of the early things that the funding for the Bitcoin Foundation also did was when there was a fork that occurred back in, I believe it would have been late 2012 or 2013, because of a change in the database structure. We actually had a fork that went on for about 4 or 5 blocks before it was detected and reversed. We used the network alert system at that time to get messaging out to all of the clients so that everyone would be able to switch to the correct fork when the messaging alert system was still in use back then. But the funds for the foundation compensated all of the miners that had mined on the fork that was abandoned. Because when you have a legitimate bug in the system where it's nobody's fault on which way is forking, you choose a side, but you have to remember that there have been minor commitments to the side of the fork that was abandoned. And these people were saying, well, what about our mining fees? What about our compensation? And it has to be a neutral player like the foundation that has the ability to come in there and compensate the miners for that abandoned fork.
Well, thanks for that, John. I want to bring in Dominic here because you're a bit of an old timer. Dominic, when was your first involvement in Bitcoin? You wrote the book in 2014, but when did you first get involved? And what was your first transaction, Dominic?
Well, my first transaction was a chap called Johnny Bitcoin, who gave me some Bitcoins. And this would have been, I want to say 2011. So it was very early on. But I know that the first time I heard about Bitcoin was in December 2010, because I wanted to. I signed up for this weird newsletter for people who want to escape the system way back in about 2008. And this letter, and it was called the Captain's Log or something like that. And he used to write about, ways you can get passports in Panama and things like that. And then he mentioned this new digital currency, and he quoted an article that was in, of all places, PC World. PC World, where you go and buy your computers, Currys, I think it's now called. And for some reason, PC World magazine was one of the first people to write about Bitcoin. And it mentioned this article and this new digital currency system that's beyond the control of governments, and you can send cash across the internet and yada, yada. And I looked at the price when this article came out, and it was of a Bitcoin. And what's Bitcoin today? $9,000, $8,500. The price of a Bitcoin was 4 cents. How about that? And unfortunately, I didn't buy, and I should have gone all in with £100, and I'd be a trillionaire now. But anyway, but the first actual transaction was this chap who went by the name of Johnny Bitcoin. His real name's Johnny Harrison, and he was it was funny how Bitcoin attracted these people in the early days, and it always has, where there are people who genuinely want to reform the system. And it's one of these things when you buy your first, and Johnny Bitcoin lived in a squat in East London with Amir Tarki, who was a famous hacker. And Johnny had followed the stuff I'd written about gold. And so he was trying to get me into Bitcoin, and he gave me some Bitcoins to try and get me hooked on the thing. And but Bitcoin attracts these sort of advocates who, they want to change the system. They think fiat money's evil. They hate all the inequality fiat money creates. They hate central banking. Fiat money gives governments too much power, all that stuff. And so people kind of, invest in Bitcoin, they transact in it, and then they start becoming advocates. And Johnny was a great champion. Johnny was like getting me to introduce him to people like Douglas Carswell and Steve Baker, who were both MPs in the House of Commons at the time, and trying to get me to put him in touch so that he could give them some Bitcoins. And people just used to give them away. There was another chap called Brian Cartmel who was who was very early on to the COVID crisis and was sending me emails back in January telling me to run and hide in the countryside. But he's locked himself up somewhere in New Zealand very remotely, and he's got a year's worth of supplies. But anyway, he's hiding in New Zealand. And Brian was another guy who knew me. He crowdfunded a couple of things that I'd done, and he was giving me some Bitcoins as well very early on in the day. So it was literally people giving them away that got me started.
Well, I was going to come back to John, but we've just got a technical issue on him, so I'm going to go straight to Paul. Now, Paul, I'm going to put you a question I was hoping to ask you. Surely, you understand the technical side of how the blockchain works. And just before halving, we were on block 998, which took ages to go through, and one of them about 10 blocks before that took over 30 minutes. Then the last block took seconds. This is a question that's come through from some watching live. And why do some blocks take ages and some blocks take seconds?
It's purely based on randomness. So the network was designed to issue blocks roughly every 10 minutes, but that's only going to be roughly 10 minutes. And the way those blocks are essentially issued or found by the miners is by them entering a lottery, a permanent lottery. Which essentially begins and ends every time a new block is found. The network calculates just by a simple kind of moving average of how frequently blocks are being found. And after a 2-week period, if they're being found more frequently than 10 minutes, every 10 minutes on average, it basically adjusts the number that the miners have to guess in this lottery to try and win a block. And when they're incentivized to win a block because they're rewarded with the newly minted Bitcoins, which come along with each block. But that is purely based on random numbers. And, just like any lottery, like there's the odd guy that's won the lottery twice, which, the odds of that are just ridiculous, but it happens. Two miners, the same miner or two different miners can literally. We've had times where in a blocks there's been a gap between a block that might have been 40. I think the record's about 4 hours. So purely on natural variance and randomness, it could potentially take 4 hours. It could potentially take 2 seconds between blocks. But over time, on average, the network, sets its difficulty. If people have heard about like difficulty setting, to a point that on average it will take roughly 10 minutes per block to be found. And that's why and that's also why sometimes it should be every 4 years. But if hash power's increasing rapidly, the block times on average could even out to be say 9 minutes, and halvings could actually happen sooner than expected.
Which is why we're doing this show today, not on the 4th of January 2021.
Yeah.
All right.
Exactly. But can I just quickly? I've
got to move on. Sorry, Paul. We will come back to you. The system is so beautiful the way it's designed, and the way that there were so few or no errors. The design just sort of worked for everyone. It's something I could never quite get my head around. It's wonderful. Now I'm going to come back to John. I mean, you mentioned the fact privacy is a big thing for you, isn't it? And also you talk about coin hygiene. Now, obviously, with the virus going around, then hygiene is very important. What do you mean by coin hygiene? Could you talk about that, please, and tell us your thoughts on the importance of privacy on the internet?
Right. In the larger picture, I think we're seeing the evolving of a crypto arms battle, and in a crypto arms race, you're going to have the financial surveillance teams that are on one side, and you're going to have the proponents of privacy on the other side. We have the privacy proponents must prevail in this crypto arms race. It's not guaranteed, but it's a cat and mouse game. So every time you have a advancement on the surveillance side, you'll have an advancement on the privacy side, and vice versa. It's a little bit like the arms race that the U.S. had with Russia during the Cold War, and that's why I call it an arms race. The implications for the users, however, and the implications for the network are far more important, because you must retain the privacy of transactions to maintain the system fungibility, and the fungibility will become an economic necessity within the Bitcoin network. So we are kidding ourselves if we think that we'll be able to continue with Bitcoin in the future in the absence of privacy. I remember your last segment here was talking about regulated Bitcoin versus unregulated Bitcoin. We already have regulated Bitcoin because any exchange transaction is regulated Bitcoin. You turn over more information to an exchange than you do to your bank. Where it differs and where we have unregulated Bitcoin is in the transactions that happen between individuals or businesses that are outside of any exchange transactions. And for those transactions to continue, it will soon become an economic necessity that there's privacy with those transactions. We don't have to achieve privacy at the exchange transaction level as long as we achieve privacy at the peer-to-peer, person-to-person transaction level, because that's what we're competing against. We're competing against bearer instruments like cash, where for that system to continue, it also has to have the elements of privacy. It has to have the three main elements of privacy that Bitcoin is actually giving you in the electronic form of cash. There's no new privacy elements that are being created. They're just privacy elements that we've always had with paper cash. You have user-defined privacy. You're the one who can set that level. You have transaction irreversibility, and you have transaction confidentiality. So those elements we have with paper cash. What Bitcoin does is allow you to have that in the electronic world. The point is that it's not a luxury and it's not going to be optional. It will actually become an economic necessity in the system, and it will decide and determine. The reaction from the authorities will determine whether or not we have an above ground Bitcoin system or an underground Bitcoin system. But we will always have a Bitcoin system. Now, taking it one step further, you have Cypherpunk Holdings, which is the publicly traded company in Canada.
Which was my next question.
A privacy protocol investment company, which needs to be on your list, Charlie, for publicly traded crypto companies. I think you're missing that from your list. All right, well, let's get that updated on your list. And two of the early investments we made there were in the wallets that are supporting the CoinJoin protocol. Number one, Samurai Wallet and Wasabi Wallet. Currently, the CoinJoin protocol is the de facto leading protocol for Bitcoin for Bitcoin coin mixing on the internet, and that's why we selected those two initial companies. Others will follow this. You have Join Market out there that is an open source project that is not affiliated with a specific wallet. And I believe that you will have others that follow in this paradigm as well. It will become so easy that it'll eventually get to the point where users that are using their wallets, either primarily on their mobile phones, I think, but desktop as well, where you won't even know that this is occurring. It will become a default feature that's standard on a lot of wallets, and it's an issue that must be addressed.
I want to stay on this topic of privacy, because I think it's one that does get overlooked. We're so obsessed by price, and I think that to look at why this thing's important is important. So I'm going to ask Paul that, but I'm also going to ask Dominic first. So Dominic, tell me your thoughts on. I know you're also linked, by the way, with Cypherpunk Holdings.
I'm the former CEO, Charlie.
Are you still the CEO?
No. The company is currently without a CEO. I had to stand down last couple of months ago due to just family difficulties, and the company has yet to replace me.
Oh well,
irreplaceable.
Looking for a job out there. There's a top job in Cypherpunk.
I'll take it.
Yeah.
There you go. You got word hired. 10%, please. Now, Dominic, tell us your thoughts on what you're trying to do there and your vision for privacy and the importance of it.
Well, it was me that, somebody approached me, and they had a shell in Canada, and he wanted it, and he wanted to turn it into some kind of Bitcoin vehicle, and I was saying, well, there's no point just buying Bitcoins and holding them in the company, because sooner or later there's going to be a Bitcoin ETF, at which point this company model becomes redundant. What you should do is invest in privacy technology, and that's obviously closely related to Bitcoin. And John and I and another chap called Mo Adam were on the investment committee, and we identified 7 different categories of privacy technology. But the reason I wanted to, it was me that had this idea of being this privacy tech investment vehicle. And I was just having breakfast one day or lunch one day with John, and I said, what do you think of this? And John was instantly like, I want to join. And so John joined as chief economist. But I'm just convinced that with this COVID crisis, the need for it is even greater, because that privacy is going to be, like every bull market needs a narrative. You think of the great commodities bull market of the noughties, it was all about China growth and .com, the internet was going to change the world. And I'm convinced there's going to be a huge bull market in privacy. We know more and more about how Facebook knows this about you, and Google knows this about you, and Apple knows this about you, and people sort of shake their head and wonder. But when that information falls into bad hands or is used against you in some way, suddenly we're going to realize that we've given our privacy away without even realizing it. And so I just think over the course of this decade, privacy is just going to be a huge narrative. And the default setting of the internet is that you hand your privacy away for nothing. And I think as time moves by, more and more people are going to start paying a premium to protect their privacy. And so there's going to be a huge bull market in technologies that aid the protection of privacy. And Bitcoin has a huge role to play in that. Bitcoin mixers have a huge role to play in that. But also other things like VPNs. VPNs have seen extraordinary growth in the last few years. And, you know, there's just so much data about you, and how much data do you really want shared? So I just think there's an extraordinary narrative around privacy.
Dominic, thank you very much. And then I'm just going to wrap up with I've got one magic question for you. So you three of you. So you've got to wait for that. It's a quick fire round, and I'll give you a warning. It's about Plan B's model, the stock flow model. So you've got to give me a quick answer. And but Paul, what did you got to say about the whole subject of privacy?
Yeah, I mean, I think you know, both Dominic touched on some very pertinent points. So it's one of being that open question. Now, I mean, and I agree with them. You know, but I think maybe it's also worth kind of considering being careful about what you're throwing out with the bathwater. I mean, privacy is obviously really important. I think it is coming into the public meme. You know, the contact tracing apps that Facebook and Google are putting out. You know, I think I've heard the term decentralization mentioned 4 or 5 times on Radio 4. But it is. But I mean, they are pitching it as the idea that the data is owned by the user. I mean, whether it's true or not, and whether we have the oversight of them, that's a different question. I mean, with open source models, at least they can be kind of vetted. But you know, at least it's coming into public consciousness. So they're saying, no, you own your data. It's not going to a central database. And this is a conversation that in our world we've been having for many years now. And this is being had as a conversation on Radio 4. So I think that's really interesting. And that's how it seeps into the public psyche. So whether it's the big corporations which deliver those products to us, or whether that's the opportunity for the innovators in our world to do it properly and make sure it's secure. So that's an interesting, facet to the general conversation that's emerging. In terms of we talk about it's a common theme of regulated, unregulated, and John mentioned it's an ongoing game of cat and mouse, which is always fascinating because these operate like natural systems, and you've got viruses nipping at the edges of all of these services or protocols, and they find faults, and you've got kind of live bounties where if someone kind of a victorious hacker breaks into a smart contract and gets away with a bounty, or breaks into an exchange, generally the world moves on, and the community and the ecosystem learns from it and strengthens itself. So that's all very positive. But it's always said that, the money itself, or the money layer, needs to be private to maintain, that level of privacy and anonymity for the user. But it's always said that the money is the money dirty? What's the history of the money? Now, for me, the money itself is a dumb object, whether it's a pound note, a pound coin. Right? It's the person, it's the identity. So this is maybe the more worrying thing. So there's still an argument that you might want privacy on chain, but there's also potentially an argument that there's an opportunity around having a certain level of open information, which could bring more equality into kind of the economic system. Whereas, if you think about most inequality within the financial system is because of information asymmetry, where banks or someone might have privileged information. So that's one thing to consider. But the other thing I think worrying in the broad picture now is something like Facebook and Libra. I mean, it purports itself to be a stable coin essentially, but from the beginning, baked into its design was identity. And that is going to be an identity system which sits upon its own token, its own currency. But I can see legislators, regulators saying, well, you've got to be using one of these identity wallets to send any crypto transaction. Sure, go ahead and use Bitcoin, but it's got to be you've got to be handing your identity around with it. And that will just become another question of whether you're sitting within the bounds of the law or outside the bounds of the law. So that's going to be, an interesting kind of divide to pursue.
Thank you very much, gentlemen. Thank you so much for spending the time on our panel, and I wish you all a happy halving. But before you go, I just want you to do an Emperor Nero. Mark, can you put everyone onto the screen, including James? Can you do an Emperor Nero? And I want you to do everyone who's got a live camera. Yeah, Emperor Nero. Now, Plan B's stock to flow model. Ready?
Well, I don't know. I don't understand the question, Charlie. I haven't been listening to the earlier thing.
Dominic, follow me.
I usually do, Charlie. Right. So I'll take you.
Thank you very much. I'm going to hand over to James.
Brilliant. So just on that last point that Paul made, I think it's a really good one, which is about privacy and digital currency. Larry Summers was just on the CoinDesk distributed event talking about the fact that a digital dollar is preferable only because it's more traceable, for the Treasury and other government entities. So really interesting topic that's been coming at from both sides. So now over to the next topic, the third slot of the evening. We're joined by two wonderful guests on slightly different sides of the space, but we're talking about data, we're talking about research. First of all, I'd like to introduce Maximilian Engelin, who is a good friend and former business partner at ByteTree, who now leads up head of sales at Crypto Compare. Max, would you like to give us a short intro on yourself and what you've done in the space?
Sure. Cheers, James. So I look after business development and sales at Crypto Compare. We're the global leader when it comes to digital asset market data. Prior to the role, as James suggested, I actually ran a startup with him for 2 years, which was a brilliant experience. Prior to that, I actually stumbled across Bitcoin in 2013, sitting in my bedroom in South Africa. I just got my first paycheck, and I was like, what can I invest in as a 21-year-old? Found myself on Reddit and stumbled across Bitcoin, and ever since I've been pretty much addicted to it, like I'm sure most of us are here.
You didn't buy a pizza, but you instead bought a...
I bought a suit when I was in Thailand with way too much Bitcoin. Not necessarily directly with Bitcoin. I liquidated and then bought a suit. But anyway, I still got the suit. I would have preferred the Bitcoin, but yeah.
Lasts longer than the pizza. That's
cool. Yeah. No, I'll hold on to that forever. But just what I do at Crypto Compare. So like I said, we're a market data provider, and we've been around since 2013. We stand for ultra reliable and accurate market data. One of your guests earlier works with us, actually two. Mona Lisa, she uses our data as well as 21 shares to build digital asset regulated products. If you need a regulated product, certainly our data is used in at least 95% of those. I'm looking forward to hearing more about your thoughts on data in today's chat.
Brilliant. Thanks for joining us, Max. And then on the other side, we have Mr. Well, it's not a wrestling fight. In the other corner. So we have Mr. Torbjorn Bull Jensen, who is the CEO of Arcane, and I would say they currently do the best research in crypto on this side of the pond. I think Delphi is the kind of main competitor. So it's a real pleasure to have you on, Torbjorn. Would you like to give us a bit of background on what you do and what you've done in the crypto space?
Yeah, no, so actually I'm the CEO of Arcane Crypto, which sits atop Arcane Research. You can think of Arcane Crypto as a mini version of something similar to Digital Currency Group. We take an ecosystem perspective on investing in startups, but also starting companies ourselves. So we are invested in companies doing algo trading, liquidity provision, retail exchange. We have a hedge fund that we recently launched. We do the research, which is very close to my heart, since I used to work as a consultant earlier. And we also have a payment technology company focused on Lightning and kind of a managed version of something similar to BTC Pay. So my background is as an economist. I fell into the rabbit hole. I guess I fell into the hole in 2013, but I heard about Bitcoin in 2012 when a friend of mine told me to invest. I decided that I should not invest, but at the time I was studying economics at SOAS, University of London, where a lot of the kind of professors are focused on different schools of thought regarding the question of what is money. So I had a very keen interest in that, and from there it was very natural to start looking at how these theories apply to Bitcoin. Ended up doing my thesis on this in 2014 and been in the rabbit hole ever since.
That is fantastic. What was the title of your thesis?
Why Bitcoin have value and why governments are skeptical. So, and I was, it's actually very interesting because I went to my first Bitcoin conference in 2013 in Stockholm. And I remember John had a presentation there where he drew the parallel to the giant stones of Yup, the Rye stones. And I took a lot of that inspiration with me in my master thesis, drew a lot of insights from Nick Szabo's shelling out of regions of money and very much identified money as a proof of work in general, actually, but in a game theoretic sense. Yeah.
I remember that. That's back in the KC Minor days.
Yeah, and the strange thing was that I felt that it was so late, that I was so late to the party. I felt like so much had happened, and the speed of development was so fast. So I felt.
Yeah. No, you were so early. It was very interesting, that conference, because the regulator for the Swedish, I think it was the Swedish Financial Crimes Enforcement, he had in his slide, because he did a presentation as well, and then he was in the audience, but he had in his slide like one of the quotes that I had given before on Bitcoin and governments, and he was including my quotes in his financial crime slides. And so we kept in touch, ever since then. So I think it was important that he was learning it correctly.
Brilliant.
Yeah.
So Torbjorn, what is Bitcoin then? I mean, you talk about sort of trying to examine, what Bitcoin is, how it had value back then, and there's been quite a lot of developments, in the thinking at least, and the rhetoric in the space. What is Bitcoin to you, and sort of how does it have value? How has that changed over the last 6-7 years you've been in the space?
Yeah, so to me, I would define it as a form of money because it is used as such in certain situations. Most critics who claim that it is not money tend to talk about medium of exchange, especially unit of account and store of value, as if it's something absolute and not related to the context you're in. I much more prefer defining money in terms of moneyness, its ability to buy, and that's obviously dependent on the situation. My Norwegian kroner can buy me anything here in Norway, but it can't buy me, but I cannot spend it outside of Norway. Is Norwegian kroner money? Well, obviously. Is Bitcoin used to store value? Of course, it holds value over time. Is it volatile? Yes, but so is a lot of other currencies. It is used for payment. Yes, we use it ourselves in Arcane to pay freelancers working from Nigeria. I used it to buy beer, not liquidating it first, but actually buying the beer directly. And is it used as a unit of account? Well, not very much for normal commerce, but it is on-chain. And to be frank, the unit of account question is not the most important to me. Why does it hold value? Well, at the end of the day, to me, it holds its value because it solves problems that other monies cannot solve. That is both in its censorship resistance and its absolute scarcity, but also in its ability to transfer value across borders and long distances. It's the only digital bearer asset without any counterparty risk. All other forms of money, digital money, is a claim on a counterparty, which means that if you want to transfer money through the banking system, you have to send it through what is called a correspondent banking system, because if I send money to the US, my bank doesn't have a direct relationship with the bank of that merchant. So you have to have a chain of banks successively exchanging claims on each other. You could bypass that by sending a gold bar, but that's very cumbersome. But by sending the Bitcoin, the value is actually moved. And that's extremely transformational and to me extremely powerful. That makes Bitcoin the most powerful kind of collateral asset. It's the only thing that can deliver real-time settlement or something close to real-time settlement across borders and geographies.
Yes, yeah. It's certainly come a long way. It's an interesting point about being, the only form of money that doesn't have counterparty risk. And then on the other hand, we're having the sort of institutional trading landscape is moving more in the direction of having this sort of layer 2 settlement and trading. So you're not actually holding or trading, the asset yourself. You're just trading a sort of digital certificate on that asset because, they want. Apparently 10 minutes is too long in order to settle a trade, which you'd have to wait at least, for one block on Bitcoin and then 6 confirmations. So,
I mention that. So I think it's very important to realize that in situations where you do have trust, for instance, within a country, within a trading platform, to leverage that and settle your balances on that database is potentially way more efficient than leveraging the trustless Bitcoin blockchain.
So
However,
you're separated into
if you're
trust
crossing
and
trust
non-trust.
borders, yeah, but if you need to cross trust borders, for instance, sending it over long distances to a jurisdiction where your local law doesn't help you at all, then it's well worth using something like Bitcoin. And also with Lightning, you actually see derivatives trading, leveraging Lightning deposits. I tested it recently.
Fabulous. So we'll come back to that shortly. Maximilian, I'd love to hear from you about, how. So we've just had the Bitcoin halving. It's officially happened after 4 years. The last one was 2016. There seems like there's a lot more going on in the space. The price is higher. There are more users, more active addresses. There are definitely more people registered on platforms as Coinbase and Square. Do we see it in the exchange volume? Are people trading more these days than they were in 2016?
Yeah. Roughly, just to give you an idea of how far we've come since the last halving, or 2 halvings ago now. Spot exchanges used to rarely exceed $1 billion back in 2016. Now, in today's market, we regularly exceed 30 billion. So in a span of 4 years, we've 30x the volume. A lot of people, are dying to see $1 trillion Bitcoin market cap, if not more. In 4 years' time, it's probably not that, hard to believe, considering how much volume is increasing. And also now that we're seeing derivative exchanges, as Bjorn has just mentioned, that will integrate stuff like Lightning and, of course, become more and more regulated. We've seen the CME do crazy volumes since they've started. And I just think this landscape is pretty much unrecognizable since 2016 when you look at Bitcoin volume or exchange volume.
I mean, you mentioned derivatives. We've seen, BitMEX used to be the kingpin, and now we've got the likes of Bybit coming through. So, what is the Bitcoin options market sort of telling us about? Were there any signals up until halving, and has it behaved differently around halving and after halving?
Well, when you look at derivatives, there's not so many options derivatives exchanges right now. So Deribit own about, I think, like 80% of the market when it comes to options trading. Typically in traditional trading, options traders usually are very well informed. They're quite a complex, asset to trade. But if we were to look at the options leading up to the halving, there was a higher strike premium on Deribit, showing that the options players thought there was more of a downside risk than a potential upside risk. The last snapshot that we looked at was the 3rd of May, and a few days prior to the halving, people that were betting on options saw more of a possibility for us to lose value than gain value going into the halving, which I think they settle in 3 days' time. The next options for Deribit on the 15th of May. So anyways, it's still a very, novice sector when it comes to options trading. I can't wait for 4 years' time how much data we will have on options and how much insight it will give us into, market movements. But yeah, we've come a long way. Derivatives are great for price discovery and also for research. So,
do we know where the volume? I don't want to put you on the spot, but do we know where the volume sits between the sort of total options market and the spot?
What options volume?
Derivatives, anything sort of non-spot versus spot.
Yeah. So we just did our exchange review.
Oh no! I think we lost him.
Lost? Oh, sorry. No, I'm just checking the actual. Can you guys still hear me? I've been given a notification that my network's unstable.
We can hear you. You came back.
Nice. Yeah. So I think, like, from what I can see, only 28% of the volume in April was from derivatives markets, but prior to that, we've seen it as high as 40% sometimes.
Okay, but
volumes, but options is tiny. Like options is like less than 1%. of overall volume.
Right. Okay. Well, that's good to see. I mean, there's still a large spot sort of market in the space. It just strikes me that these big volatile price moves like the one we saw on the 12th of March, the one we saw a few days ago, is because and I think Paul Gordon alluded to it yesterday, is that during these sort of price ranges, we've essentially got just a huge amount of option and derivatives trading, and the kind of spot market. So the hodlers, are quite well based below the 8,000 mark. So essentially, there aren't many buyers and sellers during this range between 8 and 12K, but there is quite a lot of options trading going on.
But there's a lot of volatility in this range, right? There's a lot of great money to be made in between 8 and 10 grand.
And to be lost. So
yeah.
So zooming back out to we talked about the stock to flow earlier, and I noticed Torb, your thumb went down, which we're very pleased about at ByteTree, certainly. So what is it about the stock to flow model that is maybe you can give a sort of a brief intro or overview of what it is and why you think it doesn't really sort of play out.
So it is a regression trying to predict the future value of Bitcoin. And as its regressor or explanatory variable, it's trying to take scarcity. So there's no doubt that Bitcoin derives its value from being scarce, and then the value has to appreciate when more people demand it. But the problem I have several issues with this model. One, I don't believe in any models that are that publicly available can predict a future price of a highly liquid and traded asset. Because if it were right, the mere fact that the model got known or discovered would change the kind of dynamics in the market, so it wouldn't be true anymore. So I find it very strange how a lot of libertarians with a kind of favoring the Austrian school of economics, and Austrians tend to not be very fan of econometricians, and then suddenly with the stock to flow model they tried to do a lot of different econometric tests to prove its validity. And although a lot of those tests have turned out to not be valid after all, that's not really where the discussion is. The discussion is kind of one step before that, which is the model doesn't account for demand in any way. And it's very clear to me that Bitcoin's price is primarily demand driven. So I think that scarcity is really important. The model gets that right. And then people maybe rightfully think that Bitcoin will appreciate in the future. And then you have this model that kind of give you an excuse for having that belief, and then you build up a cult around it. So it can actually end up being performative, or kind of through a reflexivity type of dynamic where people kind of putting a lot of value on the prediction from the stock to flow model behave as if it's true, and then for a period it can turn out to be true. We've seen this in the market before, especially when Black Scholes was released. The pricing of options was not following the Black Scholes model prior to its existence. After its existence, it had perfect fit for several years. But it's just a mere premise that you can do a regression and predict the future value of an asset with certainty. It doesn't make sense.
Yes.
Torb, this is music. This is music to my ears. Would you like my job? Would you like to be chairman of ByteTree? I mean, I can't make you the founder because we can't change history, but you just put it so well. And I thank you for that.
Oh, thank you.
It's a big relief for Charlie. It's something we've talked hours and hours about. And so, okay, while we have you, I think another interesting dynamic that we spoke about in the run-up to this is that, how does the network continue to sustain itself when the block reward, so we've just had the halving, when the block reward cuts in half. So, miner revenues go from 18 million a day to about 9 million a day. At the same price level. So, is this going to work? Will the network remain secure? What's next? What do we think will happen?
I think for the indefinite future, it's impossible to say how this will play out. But in the near future, it's not an issue at all. And we have to remember that the current subsidy is still a subsidy. So it might actually be the case that we spend too much resources on mining, that the network is too secure. Also, as Paul pointed out in the previous section, prior to the halving, we had exchange rate halving with the same effect on miners. So the exchange rate is much more important for kind of the changes in the mining reward in form of the coin base than the halvings happening every fourth year. Another interesting observation is that I think it was a couple of years ago, or at least somewhere back in time, miners actually sometimes produced empty blocks. They didn't take the hassle of including transactions for the fear of being orphaned, for the block for being a little bit larger, taking a little bit more time. And it made sense not to include the transactions if the transaction fees is too small a percentage of the total reward. But right now, I think we've seen fees spiking up to close to 20% of total reward, which means that it is economically nonsensical not to include those transactions. So miners will be more incentivized to include the transactions. And lastly, I think one thing that's really important to understand is that as long as Bitcoin remains the biggest SHA-256 mining blockchain, and we have specialized hardware mining this is that you cannot use for anything else, a lot of the security is derived from that, because you don't have a lot of computing capacity you can suddenly hire and attack the Bitcoin blockchain with. Also, for a lot of transactions, waiting a little bit longer for a little bit more confirmation is not a problem. So if you cut the reward in half, say that kind of naively that would translate into a halving of hash rate, well, wait twice the length. And you'll have the same level of security. So, and especially with more off-chain type of transactions, be it Lightning or Liquid, having a longer waiting period for the closing transaction should not be a big deal. So I'm not too worried about the question of kind of the viability of the rewards going to miners, at least over the next 5 years, and we have enough issues to solve in the meantime.
Yeah, it's an interesting distinction, isn't it? That fees need to increase in order to continue to keep the incentive. I think it's a really interesting point that you make about whether the network is too secure, but as we add more layers on top of it, sort of layer twos, if we have smart contracts on Bitcoin or digital gold, as we're going to talk about later in the show, then we need all the security that we can get, and I think there needs to be this shift towards more of an understanding of a fee market, that you're paying for something that is really incredibly secure and decentralized and trustless, and that's a real privilege to have space on the blockchain.
Absolutely. Yeah. But I think it's also really important, because people think that if you have an evil majority, like a 51% attack, they can do anything to the blockchain. They can steal every coin. They can rewrite all history. But that's very far from the truth. So if they try to rewrite history far back in time, that will be extremely expensive, which means that and they cannot steal coins they haven't owned previously. So in worst case, it just means that you'll have to wait a little bit longer for that super confirmation you want from the on-chain transaction.
Okay, that's a really interesting perspective. Actually, have you written anything in the research division of Arcane that you could send our viewers to sort of look into that?
Not on fees yet. It's on my to-do list, but there's a lot on the to-do list. But I think especially around security and mining, there's a lot of misunderstandings, and there's also a lot of good blog posts by prominent Bitcoin developers that are not well known well enough.
It feels like something we just don't want to take for granted, because
absolutely, I agree. But Yeah, and it's also very likely that on-chain fees will increase. We see more and more batching, which means that the cost per single transaction can be low at the same time as you pay a higher total fee, stuff like that.
Yeah, very true, very true. So Max, what things does as we sort of wrap up this session, what needs to happen for Bitcoin in order to sort of fulfill its potential, or just to continue to grow and be recognized and useful?
Well, a lot really. It's still an adolescent, not even. It's 11 years old. It's got a long way to go. What it has done is never been compromised. It's slowly but surely on the tongues of traditional asset managers. CNBC love a good Bitcoin banter, but the way I see it actually going, the full distance, being around when we're still in our latter days, is for it to really peg against what I believe one day will be digital monies, so digital pound, digital dollar, and maybe one day the treasuries will have to hold X amount of Bitcoin to hedge or to back these digital monies. So much like how fiat money used to be backed by gold. Anyway, that's looking far into the future. But in the short term, let's say 6 to 10 years, I think we need to find regulated products that people trust and increase and improve UI. And as was discussed earlier on, is for the next generation of people that use digital money is to really value privacy and value owning your own wealth. And I think if this doesn't shift, this financial crisis doesn't shift a lot of people's opinions, there will be another one in 10 years' time. And then Bitcoin will really have its heyday. So in terms of adoption and widespread belief, I think we're still 2 or 3 years away from that.
Brilliant, thanks, Max. And so, last question over to Torb. So, the one from the audience, from Toby, who says, "I'm a fan of Bitcoin, but like to consider the opposite or contrarian view. What do you think would make Bitcoin collapse or become irrelevant for any reason? And how likely do you think that is?"
Oh, that's a very difficult question. I think lack of adoption is a big challenge, because if enough people own it, it'll be protected from harsh regulation. And I think that harsh regulation can really stop most of its use. Not 100%, you can push it down to the black market, but it'll make it, governments can make it very difficult for people to use Bitcoin. So I think we have passed that level, but I'm not sure yet. For instance, in Norway, around 5% of the adult population owns Bitcoin. We should push that. You see the same numbers in Canada and Sweden. You see some higher numbers in some developing countries, but that's amongst those with internet connection. But the more ownership, the less likely it is to be crushed by regulation. And I think that crushing by regulation is a real threat. Of course, there are the potential of technical challenges. It could be anything from an inflation bug to something quantum computing. I don't have the technical expertise to really evaluate that, but there I think that although it'll be challenging, social coordination, a hard fork will kind of save the project. And to me, it's very important to realize that while most if you look at complex systems, you have this kind of saying that any complex system that works evolved, started simple and grew big. And then any attempt to design a complex system will fail. And I think the reason why I find it so hard to find out exactly why Bitcoin will fail is because it will meet every challenge and every hurdle by evolution and kind of work its way around it. So it'll be more of a roadblock rather than a full stop, I think.
That's a fantastic place to end. Bitcoin from a Darwinian view. Bitcoin is. But
could I add one tiny little point at the end?
Yeah.
Try to be really quick. So you had a question before this, was for me to prepare, was kind of the evolution of Bitcoin. and how it went from kind of being magic internet money to kind of freedom money, both for criminals and those who believed in privacy, to be a speculative asset. And I see a lot of people now cheering when Wall Street is coming in, which is a bit puzzling to me as a cypherpunk kind of movement. But what I truly think is the next step is as a universal payment instrument. And there's been 2 hurdles for Bitcoin to be used as a payment rail. The cost of going fiat Bitcoin and Bitcoin fiat has been too high. That's been pushed down. You can do that for sub basis point cost now. You can do it through your bank. The other has been technical scaling to send a lot of transactions with Liquid and Lightning. We now solve that simultaneously. And with the apps like Strike in the US, where you can have money in your bank account, at the same time pay a Lightning invoice, with Tesla Coil, our solution, where companies can receive a Bitcoin payment either on-chain or off-chain, but get it automatically into their fiat of choice. I think we'll see over the next 5 years an explosion in Bitcoin as a payment instrument in the back end, hidden from the end users, together with the other use case as an investment asset. But yeah.
Torb, thank you so much. It's been a really, really fascinating conversation, and I'd love to continue this with you in the future. Hopefully we'll be doing more of these and we can dive into it. I think it's the really interesting points of Bitcoin. So Torb of Arcane and Max of Crypto Compare, thank you, gentlemen. I'll now hand back to Charlie to introduce our final guest and panelist, the one and only Mr. Daniel Masters.
Good evening, Daniel, or shall I call you Danny?
Gentlemen, it's a pleasure to be with you. It's a little dark here, so I'm just adjusting my lighting.
I thought that was the sun in Cyprus, but I thought it was a bit later.
It's that sort of nighttime, yeah.
Yeah, quite. Well, thank you for coming. And you know, disclosure, Danny's on our board, so I think I should probably tell everyone that he's a friend of ours. He's one of us. So thank you very much for spending for taking the time to take your evening to spend here. Now, I was talking the other day about DGLD with one of your colleagues. Now, DGLD is gold on the blockchain. And this conversation has gone in many ways. We've looked at the history, the Bitcoin Foundation with John Matonis. We've looked at privacy with Paul Gordon and Dominic Frisby. We've had some fascinating research with Max and Torb and so on. So, it's let's talk about application. So why do you think gold needs to go onto the blockchain, and what's where are you going with this project?
All right. Well, good evening, everyone. I have to, for the sake of housekeeping here, Charlie, unfortunately, I have a hard stop in half an hour because I do have to jump onto another similar event. But we've got plenty of time to talk about these things. So, gold on the blockchain. I think that should best be broken down into a few discrete use cases. And, we can put those in sort of framework of current circumstances as well, which I think speaks even louder to every one of those use cases in actual fact. So let's talk firstly about, let's just lay out all three of them up front. So number one is a stablecoin and a shelter from Bitcoin volatility, for which there are, a lot of alternatives, but we'll highlight where I think DGLD and gold tokens in general score in that regard. There's a use case in terms of a currency. So as we've seen in the recent turbulence, some of the emerging market currencies, Brazil, Mexico, Turkey, South Africa, just absolutely destroyed and probably going to get worse. So and in fact, actually, I believe in Lebanon, I think the currency is actually totally collapsed. And this is all a function of the turbulence in global macro markets. And thirdly is the use case for the traditional ETF buyer. And there are hundreds of billions, I think, of dollars in value tied up in gold ETFs. So let's just take those three one at a time. Now, I think, the use of gold as a token, I think can best be sort of summarized as the epithet gold standard 2.0. And I think it's very important that, we view this like, in the context of these distressed currencies that you currently have. You might remember, back, I think it was in 2015, in the early days of Bitcoin, when Bitcoin was really struggling to sort of get above $200 or something. One of its big rallies, which I think was from sort of 200 to 300 at that time, was indeed around the issues that Greece had. And at the time, there wasn't any gold tokens around, but Bitcoin was around. And the Greek finance minister, actually, as it turned out, and in later disclosure, had talks with some of the Bitcoin community about whether Bitcoin could be, a viable currency for Greece. It would have been a wonderful thing for them, actually. So this is a real deal, and I think that as we enter this period of unqualified and unrestrained quantitative easing, we're looking at a regime where money supply is absolutely exploding. I mean, relative to global GDP, you're talking about doubling by the time we're done with this virus, and level switch. Absolute levels and acceleration, which dwarfs 2008. And the other, thing on the flip side of that, you also got to be conscious that the backdrop is of a declining inventory of goods and services. So, rapidly inflating money supply, rapidly depleting or depleted goods and services. And it begins to sort of look a little, and I'm not trying to be alarmist when I say this, but I don't think we're going to go quite this far. But, the hyperinflation that was subject to the German citizens were subject to in the Weimar Republic happened because, after an argument about whether they should pay reparations, the German population went on strike. The goods and services collapsed in production, and the government decided to pay everybody anyway. And that led to the collapse of that currency. So I think governments are really playing with fire at the moment. There is still a concept of full faith and credit in the US government. But, we're going to see a inventory of bonds sold in the public domain in the second quarter, likes of which the market's never experienced. And again, as though things aren't bad enough, while doing that, the President of the United States is trying to finger China with the coronavirus outbreak. And as I was waiting for this call, there's something came across to Bloomberg that indeed the House has now put forward a sanctions bill on China for that reason. So if you think the Chinese are going to show up in big numbers to buy the largest bond auctions in the history of mankind, I'm not so sure. And I think the sniff, it doesn't necessarily, we don't need to go from here to hyperinflation, but the sniff of panic or the sniff of lack of control in the as the market tries to fund these massive expansions in credit, I think could really put a lot of currencies into a very volatile, if not terminal state. So, you have in gold token, in DGLD in particular, and I highlight our relationship with blockchain.com, a partner very carefully selected because they have the world's largest wallet infrastructure. There are 48 million wallets, and there are hundreds and hundreds, if not thousands, if not millions of wallets in the type of countries that could well end up looking for an alternative currency. So that's one use case. The second use case is in the a shield from crypto volatility, and that's kind of related, and I think it's become more related as a use case because of the circumstances we face. So when you're long your Bitcoin, there'll be the hodlers that will be long no matter what, but I think the vast majority of people actually trim their Bitcoin positions from time to time. So what are your alternatives? You can sell your Bitcoin and you can leave a credit balance on an exchange. Probably not a great idea for security reasons. You can sell your Bitcoin and you can take that money out of an exchange, put it through bank. And, we all know the issues that happens when you try and move large volumes of crypto through your bank. Chances are you won't have a bank. So that's not a great option either. That leaves you then you move on to US dollar tether and USDC and the dollar-backed stable coins. And my description of these dollar-backed stable coins is lipstick on a bank. Because ultimately, in as much as there are any dollars, and in the case of tether, there clearly aren't enough, but we don't exactly know how many and we don't exactly know where. Doesn't stop it from being an $8 billion asset in some miraculous suspension of disbelief. But nonetheless, if you're using one of the more legitimate coins, then your money's in a bank. And And again, let's not forget, I'm here in Greece, and let's not forget that when Greece had its major financial crisis, the government simply stripped your money out of your bank account. And if your stablecoin is backed by a bank account and the money is stripped out of that, your stablecoin is screwed. So that is not a great option either, in my view. Now, what's great about DGLD, and actually I'll now split that and sort of separate ourselves from the other two main coins, which is Tether and Pax, is our coin exists entirely outside of the banking system. Because what we're trading with mainnet DGLD is essentially a depository receipt for allocated Swiss gold. And it's designed in a very robust way from a regulatory perspective, so that gold remains your personal property through all stages of the token lifecycle. And that has some profound implications in terms of how much purchase a regulator or an agency or government can get on that. So, it's not subject to any MiFID rules. It's not subject to any collective investment fund, AIFMD type legislation. It's not subject to commodities legislation because there's no hypothecation or leverage. And it's your property. So it has very resilient qualities in that regard. And so for me, as a crypto investor, if I'm coming out of Bitcoin temporarily, then if I'm facing all of those options, take my cash out, leave my cash in, take a stable coin in and backed by a US bank, I kind of want gold, and I'll live with the extra, 3, 4, 5% volatility when I'm coming out of the 120% volatility regime. I'll live with that extra volatility for the sake of not having my funds essentially interdictable, many, many ways by banks and their proxies. So that's that. That's third use case. And again, these things, the crisis has actually served to merge these together, and you'll see the color around this would support that theory. So, gold ETFs, huge marketplace, and a lot of people buy gold ETFs for, two main reasons, really. One, is it going to be a store of real value? Well, we've seen Fed fund rates go negative this week for the first time in history. And before long, at this rate, and that's what the market's predicting in 2020, all of 2020, the prediction is negative interest rates in the US now. So immediately you're getting a haircut, which is not great. And not only that, you're also trying to think about whether you're actually, if you're going to get your gold. So never mind if you go into a bank account and when you're way out and you get a haircut, are you going to get your gold at all? Because when you buy a gold ETF, you've got or an option, a call option on the gold ETF. Even better example, you've got a call option market maker, a call option exchange, a call option clearer, probably some sort of a transfer agent, and that will sit on top of an ETF which has got an SPV and another transfer agent and a pricing agent, and the list goes on and on. And really, if you're really trying to hedge against systemic risk, i.e., we thought not 2 weeks ago that it was possible the banks would close and the exchanges would close. Guess what? You have no access to your gold at that point. Well, with DGLD, you can rock up in Castle San Pietro in Switzerland with your iPhone, with your DGLD keys, and you can load the back of your pickup truck with gold. So it really is very resilient to both resist to legislation, to interdiction, and to systemic risk. And look, a lot of those properties are what everybody loves gold for. But indeed, in buying a gold token, you're getting a security around your gold in a top quality vault. You're getting frictionless pricing. You're getting the ability to not have to pay a big markup for small format gold because you're buying wholesale gold, and yet you can do it in very, very small quantities. So long story, but that's the 3 use cases for DGLD.
No, fabulous. And I think going back to the basic premise, I think the point you made, I think is a good one. That it's kind of odd that there are some people out there who think that gold as the enemy of Bitcoin and Bitcoin's job is to overtake gold. Actually, they're natural best friends. One's just the old school version and one's the new school version kind of thing. And if you're coming out of the racy new one, which has the ability to go down a lot when things go wrong, as we've seen a few times in the past, where a bad bear market for gold is a third, it is a good stable coin, isn't it? And you're still maintaining that spirit of the space and arm's length from the system and so on. I would say on the ETFs that most people buy them because it works from a regulatory perspective, and you're trying to invest in gold, and you're not betting on the end of the world necessarily. You're betting on falling real rates and that sort of thing. And the end of the world investor has a very different hat to a diversified investor, assuming the world's continues as a going concern, notwithstanding big economic shocks and problems and that sort of thing. And but I do take that point, and it's what it's worth, Danny. I mean, I'm writing an article for the Alchemist magazine tomorrow morning, and you know the answer because I've already put it on the Denver Gold Conference 2 months ago, and that's gold 7,000 by 2030, and that's not bad. But Bitcoin outperforms gold, of course, doesn't it?
Yeah, but like you say, Charlie, I mean, I'm jumping onto a call later where I'm fully expecting a sort of pitch battle with one of these Bitcoin maximalists, which is ironic, really, because I spent the last 10 years fighting, the traditional legacy system, and I am a Bitcoin maximalist. But I think you need to look at the intersection of, traditional finance and digital finance. And we're trying desperately to squeeze Bitcoin into that intersection. We do it all the time, trying to put MiFID transferable securities on exchanges all over the world, and it's a thankless task. We get it done, but it's very, very difficult. So, to me, the benefits of, where Bitcoin and gold coins or gold intersect is if you are comfortable with a gold coin, which is a much easier sell to a traditional investor, because you're not just got digital and crazy asset, you've got digital and traditional asset. It's an easier sell. And that universe is enormous compared to the true crypto universe. And so rather than trying to push Bitcoin into that intersection space, which is very hard to do, why not seed that intersection space with sort of a gateway crypto, crypto on your friendly asset, whether it be a dollar or whether it be gold. And I think actually, I can't think of anything better for Bitcoin than for the than the proliferation of stable coins, whether they be Chinese yuan stable coins or US dollar coins or gold coins. I can't think of anything better to actually get investors more comfortable with hardcore, distributed, trustless crypto, because going cold turkey from the old world to the new world is very difficult for a lot of people. My final point, just on the ETFs, is if you look at things like ETF securities and PHAU and instruments like that, GLD, the issuers go to great lengths to essentially pool this gold in an SPV, write debt securities, link the gold to the debt securities, use a security trustee to make that link, such that the securities holders on the stock exchange in which it trades can look through the issuer via the security trustee to the gold that's in the depository, that's in the vault, right? So, the PHAU prospectus is probably 160 pages long, and all it's trying to do is link that gold to the buyer of the security, right? But at the end of the day, you've still got the risk right at the bottom of that stack that gold's in someone's vault, and you've written an ETF on it. That gold's in someone's vault. Now with DGLD, you cut all of that rest of that stack out. And what you're trading is the same digital depository receipt that would be fed into the SPV at the bottom of the ETF stack. So it's actually a lot simpler as well. And it doesn't I think it materially improves your performance risk, regardless of the motivation for actually buying the asset.
So on the one hand, if I can, there's a question from the audience I think is pretty interesting. We have the store of value of gold that's been tested over many more years than Bitcoin, and the sort of store of value, but also big upside that Bitcoin can give us. I mean, how do the two mix together? What would a portfolio look like? Are there any sort of...
It would look like my portfolio.
Where you can have both the best of both worlds.
Look, I've only had for my personal investing portfolio, I would tell you this 5 seconds, it's about 95% Bitcoin and 5% gold. And that's pretty much all I own, in the liquid, space.
So, Danny, why so conservative? What's your fear of 100% Bitcoin?
Maybe I should tidy that up a little bit. You're right. I'm not sure, but and I'm very bullish for Bitcoin right now for a variety of reasons. But nonetheless, there have been periods of time when I haven't been, and or when indeed, strange as it may sound, Bitcoin can actually be very non-volatile for a period of time, and then you may actually want to cycle out into something else. And let's not forget, you can't really use Bitcoin very effectively as collateral. You can use DGLD as collateral. So you can park that, hypothecate it, go borrow the dollars you want, buy the stock you want, and you'll be fine. So yeah, look, I just see, I don't see dollars, gold, Bitcoin as sort of red, amber, green. I see gold as risk off and Bitcoin as risk on, essentially. And I'm pretty risk on at the moment.
I want to put 2 quick questions to you from the audience.
Sure.
One, what about altcoins? Quickly, please.
Altcoins.
Yeah.
Altcoins.
Yeah.
I'm not sure exactly what you're going to define by altcoins. I would say that a large number of coins, certainly emanating from the ICO space, have been massive disappointments. Really, we've had a bunch of write-offs. I've had a bunch of write-offs, 100% write-offs. And I'm not sure why, because I think that in some cases the companies that raised that money had enough to do enough to make their companies viable, and yet many of them didn't. And even the ones that are, we're heavily involved in Aventus, for example, which we did their ICO with them, and we're big holders in that company. It's a great technology company. They did raise a lot of money. They have spent it the correct way. But their token, still hasn't performed at all. It's been very, very, very weak. So there's something wrong in the econometric model of altcoins if you're talking about ICO type coins, and it needs to be explicitly fixed, and that's not helped by the intervention of the SEC.
Okay, and finally, the last one. This is it's the penultimate question because there's another
Sure.
question.
Sure.
What might make Bitcoin collapse? This is a question that we've had earlier, and I thought I'd ask.
Yeah, I was listening. I was listening to that. Well, it's something that I worry about and I fight against all the time. And I think, in actual fact, we've probably come closer to that than people care to think. Let's look back to the summer of last year and the FCA's consultation paper CP 1922. That paper essentially was a beachhead that sought to essentially destroy Bitcoin. And the FCA made a statement in writing that they thought Bitcoin was a worthless asset and broke their tech neutrality rules in doing so. But their game plan at the time was to prevent the sale of crypto linked to securities to retail and effectively to wholesale as well, because they were going to look through the wholesale owners. And they even at one point tried to start regulating open source code that was writing software applications for the Bitcoin network. And we fought tooth and nail against the FCA, and we blew up our relationship with them because we brought in a lot of heavy hitting politicians into that debate. And I don't think they appreciated it. But it was the right decision. And that ban did not happen in the end. But had they had a victory there, their full and stated intention was to extend it across multiple, not just the perimeter of regulation, which they already had, but to extend it to wallets, custodial wallets, non-custodial wallets through the software link, and into exchanges, and to apply AMLD5 in a really hostile way. I think these guys came just back from the edge, and you can't underestimate how influential the FCA are in terms of all of the European regulators, because the battle we had with them there reverberated in every regulator we deal with in Europe, which are many. So that is an existential fight. Now, that's why I cannot tell you how delighted I am that Paul Jones has stepped up. One of the biggest macro fund managers in the world. Now, does the FCA really want to turn around to come with someone like Paul Jones, and Julian Robertson and Lewis Bacon and Mike Platt and say, you know what, we're not really prepared to play in the products that you $28 billion worth of capital wants to invest in. That would be suicide. So I'm hoping we've sort of crossed a Rubicon there. And I think this JP Morgan news about servicing Coinbase and Gemini back to back with the Paul Jones news. I actually tweeted this evening at the FCA saying, wake up, guys, look what's going on here. Is Britain going to get left behind? Because clearly the barriers are coming down.
So do we think this market shock from COVID-19 that was a black swan or a white swan, however you want to look at it, do we think it was one of the best things that could have happened to Bitcoin at this time?
I wouldn't want to wish COVID-19 on anyone for any reason. I say this in an ironic way, that I can't think of a better event for our business. In every way, shape and form, it supports Goldcoin, it supports Bitcoin prices, it supports Bitcoin client flow. It's brought other people into the business now, which are supporting the regulatory perspective of it. Our Goldcoin and Bitcoin are both COVID-friendly instruments. They don't require banks to work in close proximity. They don't require ATM machines. They don't require credit cards. There's lots and lots of positives have come from that. And obviously the economic carnage, although I learned this lesson in 2008. Our commodities fund was one of the best performing funds in the world in 2008. We were up 28%, I think, on about 5 vol when the rest of the market halved. But while we were busy high-fiving each other, we failed to notice that half of our clients had gone bust. And our assets, having gone up 30% in performance, went down 50% in redemption. So, you have to be careful what you wish for, and I'm hoping this isn't that bad. But I have to be honest and say that it's actually probably Bitcoin and crypto and digital gold are probably one of the few beneficiaries.
Right. Well, Danny, thank you very much. I think that our viewers have had enough. We've been on air for what's coming up to 2 hours now. And
God, Charlotte, you're really pushing the envelope there, aren't you?
I know. We had to pay by the minute or something for telephone lines or what have you, which you used to do in the past. So you don't these days. Everything seems to be free. So, look, Danny, thank you very much. And James, do you have any final comments that you'd like to say to our viewers who have very kindly stayed with us?
I would just like to say, come visit us at coinshares.com and dgld.ch.
Thank you, Danny. Now, James, do you have any?
All right, guys. Have a good evening.
Yeah, thank you very much. Thank you, Danny. So, signing off words. It's been a great event. We've heard from a lot of speakers from across the industry. And of course, this won't be the last time you'll hear from us. We are planning to do more regular webinars during this new environment we're in, looking a little bit more into the on-chain data that we specialize in at ByteTree, as well as bringing in other research analysts to discuss. So hold tight, keep an eye on us. Let us know your thoughts and feedback. We're always welcome. Charlie, Mark in the control room, and the whole team at ByteTree for putting it on. Thank you. We're signing off.
Should we do a wave? Bye.